All right, if you're an entrepreneur, the chances are that you have multiple businesses. And if you have multiple businesses, chances are that you're transferring money in between them. And not only that, like expenses for one business are probably really for another business. And income from one business might be for another business. Totally normal. Let me show you how we deal with that from an accountant's point of view. So we've already established that it's normal, right, to intermingle sort of accounts. So in this example, we have a paying company, right, where that's where the ad bill hits. We have a roofing company, right, where the reimbursements hit because there's a subcontractor using that ad account but paying the roofing company because they use Stripe and it's easier. So on the roofing company, the income is overstated. And on the painting company, the expenses are overstated. And it matters because your numbers aren't right? And if your numbers aren't right, you can't figure out like what's the cost per lead based on the ad spend. Like what do my numbers actually look like? My P&L, what did I make or lose over a period? And really good owners have a really good grasp of the minutia, the details that make up the numbers. Even John D. Rockefeller started his career in business as a bookkeeper, right? And he had to teach himself to step back. Luckily, Dr. Digits will handle the minutia for you, so you don't have to. But here's how we untangle this lab example. We've already established that there's 3 players in this: the painting company, where the ad bill hits; the roofing company, owned by the same person as the painting company, shares the Yelp account with the subcontractor who pays the roofing company. Okay. So it's not a business problem. It's a reporting problem. It's totally normal for this to happen, but we have to back it out in some way. Okay. So here's a visual representation of what that looks like. Okay. It's about $33,000 mess for this example on a $5 million business. That's material. Okay. So think of due to from accounts like a bucket, right? Money is moving in between them, but it's not an income or an expense. It's a balance sheet account. But we understand debits and credits because we're an accountant. So we can't just, hit everything in this account. Something needs to hit the P&L or some other balance sheet account as well. So on the roofing books, right? Same owner. Income is overstated. We know that. $33,000 overstated from the subcontractor paying the roofing company. So we need to back that out of income. Okay. And debit income. We're going to credit the due to from Paint Pro account. Then on the painting books, we're going to debit the due to from account. It's the opposite entry as the Paint Pro, or opposite. I guess you could also call it, doesn't matter. Think another word. And we're going to credit the marketing expense, right? To back it out. So you don't just have entries hitting the due to from account. You also have entries hitting, the P&L as well, right? So credit on one company, debit on the other. The bucket always agrees and they match. That way you have true P&Ls on both sides, right? So if money moves between your companies, which it probably does, that's how you keep the numbers honest. I write about this stuff every week. Link down below or click on the video. We'd love to help you untangle whatever situation you're dealing with.